3. Hey, good morning. Today is Monday, the 2nd of March, 2015. This is your live Forex trading strategy session. My name is Wayne McDonald, Chief FX Market Strategist for Traders Way. Welcome to this live strategy webinar. Very quickly, British pound weak, euro strong, Swissy weak, yen weak, dollar weak, Aussie dollar weak, CAD dollar weak, Kiwi dollar weak. The only thing strong is euro. Wow. Let's do some analysis. Remember, today is Monday, so we've got to plan out our trading week. We're going to go through the trading calendar. We're going to look at the commitment of traders report, and if we can squeeze in some technicals, then by all means, because I love technicals, let's get going. Hey, trading and investing is risky, in particular with leverage, and not appropriate for everyone. Your past performance, good or bad, does not predict future results, so always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Very quickly, let's go over the news that happened over the weekend. Remember, just a few days ago, was it Friday? We did a thing about the reserve requirement ratio, and then we got into the money multiplier and money supply and central banking policy, and wow. So anyways, they followed that up. I think it's a little strange, but the People's Bank of China cut interest rates by 25 basis points. Second cut in 3 months. Which is funny because, you know, that's a big deal, but cutting the reserve requirement ratio is much, 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 much bigger. You know, cutting the interest rate, you know, what do they call it? A bazooka? Yeah, well, changing the RRR is like a nuclear bomb. So they just changed the reserve requirement ratio. And then they cut by 25 basis points. But whatever, they're doing stuff, I guess, is all that matters. Does anyone remember when the Fed last cut its reserve requirement ratios? As you know, they raise or lower interest rates quite frequently. When was the last time they took RRR? Thank you, Krakos. Right? Yeah, Krakos remembers 1992 exactly. Muy bien. 1992. Well, hey, look, they just cut RRR last week. Now they've cut interest rates. So what's the news to use here? They're admitting to the world that their economy is slowing down. It's dropped below 50. If you're measuring it, there's lots of economic reports that says anything under 50 on the scale of 0 to 100 is contraction. Well, they've been below the key level of 50 for a while now, and been near 50 for a very long time. So, for example, Chinese February manufacturing came in at 49.9. So the economy is contracting. So cutting the reserve requirement ratio and cutting key interest rates will add to the money supply and create inflation and get them back over 50. That's the whole point. So at least they're admitting it, not just playing around with the numbers, right? Some will feel that if they say 49.9, what they mean is 39.9, but whatever. Hey, look, at least they're acknowledging it and they're doing something about it. That could be good for the Australian dollar if they can get their economy back into expansion mode, because then they're going to consume natural resources and buy some of it from Australia. But if the economy is contracting, they're consuming less and less as an economy, right? All right, next. Eurozone CPI, negative. Right? I mean, there we go. That's why they're doing quantitative easing. Again, adding to the money supply, eventually increasing in inflation and consumption and all kinds of things. Okay? And so this week is just tons and tons of PMI data, right? PMI from every little Eurozone country. Liechtenstein PMI probably came out last night. But, you know, I don't know if it's really that important when we're about to start quantitative easing. I mean, we were worried about that going into potential quantitative easing out of the Eurozone, but now that we're about to start it, it's like, okay, we get it. PMI is going to be bad. Fine. Great. Next. Right? Remember, it's not the economic data per se that moves the market. I mean, you can have surprise in economic data and it jolts the market for a bit. But as more of a global macro currency trader as we are, what we're really interested in is the central banking policy, not necessarily the one-off news events, right? Do we care about Spanish PMI, Italian PMI, French PMI, German PMI, Eurozone PMI? I mean, all of that's important, right? For what reason? Well, it's measuring something in the economy. And if those measurements by and large are poor and poor for a long time, the central bank is going to have to change their policy, right? Either expansionary money supply, right, or contracting money supply. And that's what we care about. The potential for the change in central banking policy, and then the change, and then the change and the change, right? That's all we care about. So, okay, we got all this bad PMI stuff for the last, I don't know, 3 years, right? All right, finally, the ECB is going to do something. Good. Next. Now I'm worried about that. So, interesting news. I think it's valuable. You know, really good or really bad surprises might lead to scalps. That's all. And in that case, if you're going to like triage, German PMI is going to be much more important than the Liechtenstein PMI because it's the largest economy in Europe, right? And they're like the second or third largest exporter in the world. I mean, Germany is important. Okay, so on and so forth. UK mortgage approvals up, right? February PMI out of the UK, 24th month of expansion. You see the difference? Quantitative easing about to begin. You know, EU is in crisis mode. ECB is battling these fires. And then what? We're talking about Carney discussing very, very poor inflation levels, which may or may not be just oil prices dropping. But what are they talking about? Well, maybe someday raising interest rates. Well, you know, the ECB is not going to raise interest rates for 5 years, right? Well, the UK is thinking about it. They were certainly thinking about it a year ago. 2014 was a little tough. I think it started well and ended poorly, right? So we had this big, huge retracement. But all of a sudden, we're getting okay data again, right? We're looking now at, sure, headline CPI is down. If you take out oil prices, which is core CPI, you know, it's not the worst CPI in the world. But if you look at subcomponent information, wages are starting to go up at jobs. You know, people in the UK are getting jobs, and it's at the point where they're also getting larger salaries, and you know, that's the inflation that we're looking for. Not necessarily everything costs more, because if nobody has any money, price good inflation, people have decent jobs and they're getting more money for them. That means there's competition for the jobs and all, you know, I don't know, it leads somewhere good. More money in your pocket, right? As you know, more money might go into the bank. Using the money multiplier, you might put $100,000 in the bank, but the banking system turns it into $1 million. Yeah, that's good for the economy. And then what? You feel good about your job, you buy a plasma TV. Yeah, good for the economy. It's got to be sent to the store. The store has to have employees. You know, the shipping company has to have drivers, and then warehouse people, and you know, truck drivers, and so on and so forth, right? So it's all good. It's all good. If you don't have a job, or if you have a job but you know you're not being paid very much, all that kind of goes to a halt, right? Because you can't afford to save anything, and you're certainly not going to go out and make a durable good purchase, right? Poor people tend not to buy stainless steel refrigerators, right? So on and so forth. So anyways, you know, 24 months in a row of expansion in UK PMI. Well, it's better than the Eurozone with 24 months of negative, right? So blah, 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 blah. Okay. So we got a big week. Fundies-wise, I guess, why don't we just start with that? and then we'll do commitment of traders report. Okay. Let's filter some of this stuff out. There's so much going on this week. It's crazy. And last week was redonkulous, right? But back-to-back crazy amounts of fundamental news. Just amazing. Just amazing, right? Okay. ISM today, fine, good. Here's the interesting thing. Does the United States live, does the U.S. economy, is it a manufacturing economy or a services economy? How would you describe it? What kind of economy does the United States of America have? Okay. Do we care about the manufacturing industry that much? Is it a big deal if we get a really good number or a really bad number? Well, here's the interesting thing, and we did talk about it maybe a month ago. We talked about trickle-down economics as far as quantitative easing, right? The Fed makes bond purchases from treasury dealers. The dealers put the money in the bank, right? The banks keep their reserve required money, which is 10%. And 90% gets lent out, and that goes to a company, and then they put some in their bank, but that gets spent, and then that goes to someone else's bank, and that goes to someone else's bank, and that goes to an employee's bank, and then the employee goes to a car dealership, and it goes to their bank, and he buys the car dealership or the car. So some money goes to the car dealership employees, but then some goes to the car manufacturer, and the car manufacturer puts that in their bank, and that gets lent out, and that has to go to part suppliers and shipping companies, and all of a sudden, it starts with the Treasury buying, let's say, $10 billion worth of bonds, right, from Goldman Sachs. But what you want to do is follow the money over time as it goes from bank to bank to bank to bank to bank to bank to bank, and it enters the economy. One day there's like a in a car part manufacturer, an OEM or even aftermarket guy, and whatever, he goes to work and he drives a forklift and he moves pallets around, and that money that the Fed printed and gave to Goldman Sachs maybe 6 or 9 months later goes into the forklifter's pocket, right? And I think so. I think in normal scenarios, in a normal economy, when everything is healthy and we're worried about too much inflation and all that kind of stuff, and we're worried about full employment, and we're not worried about manufacturing that much because so much money is made in the service sector, right? But in a situation where we're worried about when is inflation going to go up? When is the economy going to stabilize? When are people going to buy houses again? When are people going to buy cars again? When are people going to pay down their debt? When are they going to get more credit cards, right? So on and so forth. When are they going to spend? When are they going to buy TVs? When? Well, now you want to track the money that the Fed printed. I mean, who cares if that goes to Goldman Sachs's bank account? Because the Fed bought $10 billion of bonds from Goldman Sachs. I mean, who cares about that, right? How does that help anything? Well, eventually it gets down to the common Joe, the average Joe on the street. That's what we care about. We might see that in manufacturing data. And then you think, well, manufacturing data is good, so they have jobs. And then you look at the subcomponents and how, what's the employment demand and wages and so on and so forth, right? You can really get into the micro part of it. So anyways, a good number here would be fine, just fine. As a percentage of GDP, it's probably not that big of a deal. But if you're measuring trickle-down quantitative analysis, where's that dollar that the Fed printed? Where did it go? I think it matters if it's in your gardener's pocket, right? Not just in some banker's beach house. Okay, so that's what it means, and a year from now, it probably won't be that big of a deal. So anyways, We're a service economy. Manufacturing data is coming out. All right, I think it's interesting. Okay. And then RBA stuff. Yeah. RBA, man. Reserve Bank of Australia. What's Stevens going to do? Governor Stevens. Well, they talked it down to about where we are, right? Down to 75. Here we are sitting on 78. So now what? Well, here's the thing. I think they're expected to cut. But, well, how about, let me reverse this. How many people here have read the meeting minutes from RBA and pay attention to what the voting members of the Reserve Bank of Australia are concerned about? Anybody? Just me? I guess that's why I'm here, right? So they want to stimulate the economy, but they're worried about creating a bubble in housing. Credit's getting cheaper. There's nothing to invest your money in. Your money sitting, your retirement money sitting in the bank account is earning less and less and less, and expected to earn less and less and less. And those are nominal rates, 2.25. What about real interest rates? You know what I mean? So what happened in year 2000 when Greenspan lowered interest rates to 1% and left it there for a long time? Stock market came down, and so you went to cash, you got out of your equities and stuff, and you're like, well, the only thing I can do is put this into real estate. Now, I don't think they're going to have a subprime crisis like that we had, but they already have had a housing bubble, and I don't think it really is deflated, right? So now it might go from bad to worse in that scenario just because there's nothing else to do with your money. Here's this, though. In 5 years, things will be better in the Eurozone, which means in 5 years, you're going to see better numbers out of China because America's already on board. If we can get the Eurozone on board as far as buying, plastic stuff from China, then the Chinese economy is going to come back, and then the Australian. So, I'm looking at this, 3, 4, 5 years. Okay. So, but on the short run, hey, man, so I think you're going to get cuts out of the RBA, but it's going to get more and more difficult for them to make that decision. What? So, is that a scalping opportunity, guys? Sure. Are you interested in maybe front running that? Okay. You got not 24 hours, but you got 18 hours to maybe get short at resistance, jam your stop. If they cut, this goes to 75. If they don't cut, and they say, well, we can't cut because of the housing bubble, now you got your floor. It cannot go lower than where we are. Well, not sure it can go anywhere, but the trader's logic is we've priced out everything. They said it was worth 75. It went to 75. Now they're not going to cut interest rates, which means they don't want it to go lower than 75. So therefore, there's our bottom. We've printed our bottom. Now it's much more likely to go up. So you could say, well, there's 300 pips to the downside, but 800 pips to the upside. So you start planning your bottom, right? Good. Housing stuff out of construction PMI out of the UK. As we know, we've already got good numbers, so it's going to be a good number. Great, fine. Carney's going to speak. Those are righty. So obviously, huge day on Tuesday for the British pound. So what do you think he's going to say? See, this is what trading's all about, right? What has Carney been saying when the news has been bad? Has Carney been coming out saying it's the end of the UK economy? You should have hired me 3 years earlier. It's all over. There's no hope. Right? Sell the Queen's jewels. Yeah, he's like, yeah, forget about it. Right? Don't worry about it. Yeah, inflation's down. Don't worry about it. Right, Jim. And then he gives his reasoning, right? So what do you think he's going to come out and say? Is he going to come out and say everything sucks? Pardon my French. Well, you ask yourself. That's what trading's about. Make a decision. So, do you want to be buying British pound a day before he comes out and makes his speech? Or do you want to wait 5 minutes after? I mean, just make a decision. Think about it. Put it on the radar. Create a strategy, my friend. What's your alpha? Alpha is your ability to outsmart the market, to be better than the average. What makes you so special? Well, you thought about it on Monday and made money on Tuesday. Right? Do you think a hedge fund manager's worried about it? Institutional investors? So on and so forth? Well, maybe you should, right? So think about it. What do you think they would do? Base it on some sort of logic. If you can't write a thesis on it, like if you can't give me three reasons why, then forget about it. But put it together, right? So anyways, Carney is going to speak. It's a big deal. It's a major currency. Okay, so put something in now, and maybe today you can move your stop to break even, and maybe tomorrow, boom, the thing pops 200 pips. Or you get knocked out of break even. Well, cry me a river. It's called opportunity cost, right? You got to be in it to win it, but just make sure you remove risk. Okay? All right, gross domestic product out of Canada. Is that going to be a good number or a bad number? Let me give you a hint. Oil prices have dropped 70%. Yeah, but besides that, besides that, what? It's like a gunshot wound. Yeah, but besides that, I'm quite healthy. I take my vitamins every day. I like to work out. I do yoga. Yeah, but you have a gunshot wound. Yeah, well, besides that, it's all good. So anyways, yeah, that could be a bad number. Depends on how far back they're going to measure it, right? So again, think about it. Should you be trading that particular news as a scalp? You wait for Canadian GDP. The number comes out. The market goes up and down. You sell it off resistance or you buy it off support and you pull out 20, 30, 40 pips. That's a scalp. But what if we're front running, which means you think maybe the number's going to be bad, and that can't be good for the Canadian dollar. So maybe you long USD CAD today, and it slowly moves up, and it's all fine. You move your stop to break even, and overnight it makes a higher high, and then tomorrow's news comes out, but you're already 80 pips in profit. The news comes out, it goes up and down a little bit. You make some, you lose some, and then you got the news right. Sure enough, the news was poor. They missed the numbers. The Canadian dollar weakened as everyone else gets on board. And boom, you're on your way to maybe a 3-day move because the news was right and everyone else is rebalancing their portfolio. So they're like, wow, that Canadian GDP was bad. So now you go from 80 pips to 150 to 250, 300. That's how you do it, right? So put that on your radar screen, plan it out, get ready. Okay, some GDP numbers, huh? Out of Australia. Crikey. So more back-to-back, huh? Back-to-back Asian sessions that you're trading Aussie? Yeah. Probably not a good number. Why? Commodity prices are down, they're cutting interest rates. I mean, if GDP was good, why are they cutting interest rates? So put that together. Yelling coming out, yelling and screaming. That's cool. That's on the 4th. PMI services. Okay, that's going to be important. Followed by ADP, another dumb prediction. Okay. And I find that's a good scalp. That's a really good scalping opportunity. It moves the market, so on and so forth. You can trade it now like non-farm payrolls. Okay. The correlation's been very high as of the last few years, where several years ago there was no correlation, good or bad, positive or negative. But we're on a one-way street, right? Do you guys remember what the Fed did? QE1, they did $1.2 trillion. QE2, they did $600 billion. QE3, they did $85 billion a month for like 14 months. What is that, $3 trillion? $2.5 trillion? What? Yeah, so guess what? You know, hey, $1 trillion here, $1 trillion there. Pretty soon we're talking about real money. Yeah, so guess what? Jobs have been going up. Yeah, no kidding. Easy peasy lemon squeezy, right? So correlation's been pretty high. ADP's been improving, so has NFP. In regular market conditions, without all that, money, you don't get such highly correlated. But we're on a one-way street. Okay. Interest rates out of Bank of Canada. I mean, just crazy week after last week. Amazing stuff. Bank of Canada interest rate after Canadian GDP. Holy moly, look, the week ends with Canadian dollar. Just, wow. I'm telling you, it's going to be like we either hit 120 on USD CAD or we hit 130 on USD CAD this week. Get on the clue train, my friend. It's a lot of stuff. And then ISM services out of the United States of America. Okay? That's the service sector now. We started way up here with the manufacturing. Now it's the service sector. Good. I mean, it'll be fine. I don't think that's... Now, ISM services for a while was more important than non-farm payrolls. And now NFP and ISM, they're important. It's just that the trend is so steady that I don't expect a big surprise. But what I like to do is look at when the ISM services number comes out, I look at the subcomponent, the employment subcomponent of ISM services. Okay? Good to know, right? How many people just watch the headline number? 99% of the people, right? No, you get you take the number and then you look at the subcomponent, and if employment is growing, then that's really what we care about in the market. And then wages. But at first, for now, just jobs are fine, right? So you could have a good ISM services number, but but demand for employees could be falling, which just means numbers are going to be bad in 3 months, just not this month, right? You got to look ahead, not what happened last month, what is expected to happen in 3 months. Okay, guess what? More Aussie news. Holy moly. So, what have you learned so far? Trade Asia this week. You like the Asian session? You talk Thai? It's going to be a good one. Bank of England interest rate decision. Monetary policy statement. The MPC is sort of like the FOMC. Right? What does the ECB have? Quick. Board of Governors. Yeah. And then the ECB is going to make their decision. Obviously, the decision's no-brainer. But the press conference, we can learn something new. Okay? Then Thursday, unemployment claims. What do you think? Is that going to be a big deal? No, because on Friday, we got non-farm payrolls. So Friday, and this always makes things tricky, CAD news comes out right as U.S. news comes out. Okay? Now, it's not CAD job report, which is pretty typical to happen. Okay. But some trade balance and permits and I mean just lots. So look what we got, and then of course non-farm payrolls, guys. Duh. Okay. Non-farm payrolls. I'm doing that event live. I think it's what, the 111th month in a row I've done traded non-farm payrolls live in front of hundreds and hundreds and hundreds of people over at fxstreet.com. Feel free to drop by and attend that with me, but let's put this together. Okay. Trade the US dollar this week, trade the Aussie dollar this week, trade the Canadian dollar this week, trade, well, I think the euro is going to be slow until the end of the week. So I said Aussie. Oh, and some British pound. Yeah. Yeah, some British pound. Okay, like start the week with Aussie and pound, and then it's going to be like CAD Aussie, and then pound, just pound all week. Pound, CAD, Aussie, and then of course I'm always interested in US dollar and US yen, or and yen, right? Always. All right, so there's your week. You guys want to do some commitment to traders? Commitment to traders report. You want to look at institutional positions in the marketplace, in particular the change in institutional. Yeah. And by the way, do you like having this routine? Like, are you starting to look forward to it? You're like, hey, Monday morning, time to go through the calendar with Wayne. Let's look at the COT data. It's sort of a break, right? Because I'm sure you're doing your technical analysis, right? You don't need me holding your hand. So it's more like you're a member of a team, isn't it? And it's like, okay, time to go to the Monday meeting with the team. Well, good. Because I think as a trader, routine is very, very important. Okay, very often I run my day based on routine. For example, 9 o'clock, time to front run equity open. Yay. Just, an amateur trader doesn't seem to trade with a clock. They trade the same way, they trade the same thing, they use the same lot sizes, they just same everything, but in all market conditions. And they're like, man, I can't get any consistency. What? But you're consistently inconsistent. The only thing consistent is your inconsistency. What happens if you do the same thing over and over and over again and expect different results, right? You're insane. So you got to be a little more dynamic, and really it comes down to you anticipate the market, and again, the clock. I guess all I'm saying, I don't want to get too far off track here, but the clock is very important. You should be able, when you're going to scalp, when you're going to swing, so on and so forth, right? Timing and flow, right? Strategy and tactics. So the clock is very important, very, very important. So anyways, routine. Like for example, Asia, Shanghai's going to open in 45 minutes. Time to sit down, throw down a scalp. Right? Nice. So remember, trade Asia this week. Lots of Aussie news. Okay. All right. So let's go through this. This is the commitment of traders report. Is there anybody in the room that's new to this? You've seen this, you know what it is maybe, but you just really haven't gone through it. This is kind of your first time with me doing this. You're kind of scratching your head. Or should I just burn through this like everybody knows it? Everyone's got the basics. Yeah? Everyone's got the basics? All right, well, you got to tell me. Everybody's got the basics. Turn and burn and cut through it. All right, good. Okay, we got a steady change here. Euro. Less and less net short. Is anybody buying euro? No. But traders have been exiting their short positions. Okay. My interpretation of this data, euro weakness trend will continue. Why? Because nobody, according to this data, large institutions, how about that, are not purchasing euro futures. They're only exiting their short positions. So as it sort of comes back up, it's going to find resistance, and somebody's just going to want to sell it. All right, so how do you do this technically now? And that's why I have this chart open. Okay. If it comes up to like this area, eventually, right? Might not be today, it could be tomorrow. I have this identified as a resistance zone. I would be interested in selling that. When you hit your target, this is the projected low for the week according to pivot points. Pivot point theory suggests that sometimes if you hit the pivot profit zone early in the week, and look, we opened here, right? Let me double check that. Sometimes it draws it funny. Let's do this. I've got to be careful. Yeah, okay, good. Good job. I just noticed that it was in the green zone. It's not really in the green zone. But let me just finish the thought. If it was in the green zone on a Monday or a Tuesday, very often it does come back to the central pivot, but forget about it. All right, so good. Down is fine by me. Resistance is where you want to sell. So I only see two areas of resistance, right? Where we are now. It's a very big pullback. So if we do that, that means to me that's a high probability of being in a range for a while. Okay, and the next level is up here. All right. So two probabilities here. If we stay off the first level, we're going to do this. If it pulls farther back, let's do a different color now. If it's still resistance, it's not a higher high, right? Let's say it does this. Now what's the thought? Okay, one's range bound, one's trending. Okay, you say, well, Wayne, it made a higher high here if it does that. Yeah, it did on that time frame. Okay, on that time frame. On like a 4-hour chart or a daily chart, this is what's happening. They don't see your little wave. All right, that's all they're looking at. Okay. So that's how I interpret the commitment of traders report and put it into a trend. Cool, huh? Now, the other thing is, remember, around 2 or 3 weeks, I drew these blue lines, right? What was the point of that? Let it break, let it pull back, second chance, sell it like it's hot. Why? Do you remember why? I did a nice little speech about it. Why can you afford to just let it break? Remember, I think we were even in here. I'm like, you can just ignore it. You're not at support. You're not at resistance. Just stay away. Just ignore it. Don't worry about it. Why can you afford to let it break and let it come back versus selling it quickly? Because Forex loves you, and it rewards the patient and the disciplined. If you've tried the other way, and that means chasing price, or which is being late, or guessing and gambling, which is being early, right? If you just let it break, and you're like, okay, we broke out. Now you're patient. You're just really patient. I'm going to wait. Maybe at the weekly central in here, that's a nice little sell zone. Maybe a little higher up here. But you're just going to wait, and you're going to sell, and you're going to be patient and disciplined to wait. Because it's hard to wait, man. It's hard to wait. But on the long run, you're usually better off by being patient and disciplined. Okay? So that's what that means to me. Let's look at the pig. I think this is significant. What about you? Dramatic change of direction in the Commitment of Traders report. Remember, these are large institutional investors that are not in the market to hedge. They're in the market to make money. Okay? Real money. This is not an opinion. It's not sentiment. Right? It's money. Hey, money manager, how do you feel about the market? How do you feel about the British pound? Who cares? Right? Nah, somebody's buying. Now, what's going on? Are they exiting their short positions? Yes, dramatically. Well, that doesn't necessarily mean buy the British pound, does it? That means stop selling it. Are they buying positions? Yes. They have been for a couple of weeks. Less bears, dramatically less bears, and significantly more bulls. Should you go from bear to bull? Well, if you recall, we identified the area we need to break. I think the chart looks something like this. Right, this is British pound basically. And I'm like, and let it go up. Okay. And let's make a higher high before we go all googly eye at British pound, right? But it might be setting up, be there, be ready, be aware, so on and so forth. But that is significant. Less bears, more bulls than 2 weeks ago, dramatically. And notice how it started with less bears first. The bears were the ones nervous first. They're like, I got to get out, I got to get out, I got to get out, I got to get out. And then a couple weeks later, the bulls are like, oh, I smell weakness. There's blood in the water. Right? And off we go. So, could be interesting. Now, you take that information, apply it technically to the charts, and maybe, just maybe, an opportunity appears. Right? So, I don't know. Let's just, for fun, I believe we already have it marked up. But look, that's a month worth of price action right there on the euro. Patience and discipline, grasshopper. Yeah, I forget where we had it. Oh, it must have been that other one. Because I noticed there's a target in the middle of the pivot profit zone, but okay. Yeah, so I think what needs to happen is we get past this area up here at least. All right, because there's a tendency of you're going to get like a Fibonacci retracement, you know, and this kind of stuff. And you notice how on the daily chart it wants to come down. Okay, fine, fine, fine. It probably should come down. I mean, it came up to basically resistance, right? There's the resistance, and we talked about this a week ago, maybe 2 weeks ago. So we got a resistance zone. So it should fall, or at least move sideways. But so what if price does this? Do you think that would be technically important? Sure enough, my humble opinion. And then you're going to look at the 50% retracement. You're going to look at the 618 retracement. are going to be, right? So, you know, it's not going to be easy, faux show, but the potential for the bottom of this move has appeared at the psychological level of 1.5000000. Not unbelievably complicated, right? So when do you get on the clue train? Well, you're going to need some fundamentals, my friend. Technicals don't reverse markets. They never do. So what's going to reverse the market? Improved economic data that leads the central bank to a change of policy, right? And that usually means, in this case for the UK, normalization of interest rates from near zero to near reasonable inflation. Okay, and the change from an expansionary policy to a contractionary policy tends to increase the value of said currency. When you raise the interest rate, it tends to attract investment, especially when the interest rate is positive versus the other currencies. That's a positive differential. It's just a better investment. If you're going to make money, if you bought a government treasury, you're just going to make more money than if you bought one in the Eurozone that pays you nothing, right? So just relatively speaking, but more importantly than that, because we've seen, you know, Kiwi at 3% and people don't want to buy it. Why? It's not just the interest rate differential, but the potential change in the future. So a rising interest rate attracts investment. As soon as it stops and it's not expected to go any higher, it's over. Find something new to do with your money. Okay? So anyways, down here, potential change in policy at the central bank. Hoo-ha! Guess what? Large institutional investors have already begun to rebalance their portfolio. Interesting. Okay. Japanese yen, pretty flat. We're 30 days away from fiscal year end in Japan. So, no, not surprised. Okay. This one I'm patient on. I might be patient. Well, let's go back to last year. What happened this time last year? The market went up and down over and over and over and over again for about 8 months. And then paid rewards like you wouldn't believe. It just rained pips. You just have to understand the seasonality, be patient, be disciplined, focus on the fundamentals, focus on what the central banks are telling you, manage your risk, give yourself opportunities, and that's that. Now, I'll admit, last year was very frustrating. There were many times when you go from like, you know, a trade would be up 300 pips, and 2 days later it's come all the way back. But it took you like 2 weeks to get the 300, and then it came back in 2 days, and you're just like, oh my, because you keep thinking, finally, it's broken out. Well, you know, we might be in a scenario like that, but it makes me happy because, you know, last year was really good. If you just planned it out and were patient, disciplined, and didn't get crazy and give up and so on and so forth. So it seems to be doing what it's doing, what it normally does. So I'm looking at it saying, well, this year is different from last year for fundamental reasons, and in fact, for structural reasons. In Japan, I mean, particularly the government's policies are significantly different from last year. So could this be frozen up until August? Yeah. But, you know, I don't know. So I don't think it's going to be that bad, but it could. So I look at this and say, well, this is the last month of the fiscal year for Japanese businesses. If they haven't moved money back to Japan for tax reasons yet, they're going to need to do it. There's a very understandable reason why we could have moderate Japanese yen strength for the next 3 or 4 weeks. And then, so I get that. I'm going to be patient. Okay, maybe it happens, maybe it doesn't. But if it does, I understand. Because I don't know if the if the chief financial officer of Honda is going to move money from Honda USA back to Honda Japan. I just don't. How would I know that? I don't. I guess maybe there's probably ways of figuring that out. That's your alpha. Pay attention to what, go to the Honda meetings, right? So I don't really know, but there's so many companies too, right? So I don't know which ones and all that kind of stuff. So I don't really know if they're going to repatriate the money, but I understand why they might, and I understand when that event occurs, when when the event horizon happens, right? Midnight, March 31st, and it switches over to April 1st. It's a new fiscal year, and that wave of money repatriating back to the United States is probably going to be over. Good. It'll need some time to settle and blah, 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 blah. But, I'm going to try to sell Japanese yen in April, and I'll move my stop to break even like I did last year. And hopefully it doesn't go up 300 pips, come back 300 pips, and, never got a huge breakout. I don't know. But I got to be in it to win it. I got to manage my risk appropriately, but I also have to understand the market dynamics in true global macroeconomic fashion so that I can understand what all these squiggly lines mean. Long story short, Japanese yen doesn't look like the best investment right now. It could be moderately strong or neutral for the next 4 weeks. I get it. I'm going to look to buy dips. They probably won't work out, but I'll buy them if I feel like I can get my stop to break even and walk away. That's my strategy. Tactically, I'd like to look at psych levels. If it came back to 119, even though we've been here for so long, yeah, I'd like to look to buy it again, as long as I feel like I can jam my stop at break even. And if it goes up to 119.80 and comes all the way back, oh well, I was in it to win it. Okay, that's my thought process on that. Aussie. Any dramatic change? People are significantly short. Right? Nobody really buying. So it looks like everyone's doing this. Short, 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 profit, take profit, take profit, take profit. Short, 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 take profit, take profit. But we've been in a range now for several weeks as we wait for the next decision. Well, guess what? That's this week. Do you want to be long Aussie dollar? I don't know, but think about it. We got the meeting coming up and all kinds of central banking news for Australia. Ask yourself, do you want to be long or short? Let's say I'll flip a coin. Fling. All right, you say you'd be short. Fine. Find the resistance. Wait for reversal patterns. Sell at resistance. Once you're up a few pips, jam your stop at break even, and maybe the news goes in your favor. Okay? If it doesn't, at least you had the opportunity to win. I'd rather you think ahead than follow behind, right? Kiwi, moderate increase in purchasing, no change in short positions, right? Some more bulls, same amount of bears. Not a big news week for them, but there's some correlation, obviously, with their cousins, the Aussies. So, they could be impacted by that. But right now is neutral. It's not necessarily it's weak, but it might move. Okay? Especially if Australia cuts interest rates and maybe just the interest rate differential makes Kiwi, at least on the short term, more attractive. But remember, on the long term, it's not only the interest rate differential, but it's the trend in expected interest rate levels. right? So like you have, when you account for inflation, you could use like the pi symbol, right? For inflation, but then there's inflation today, but what about inflation 6 months from now? You could do calculations saying, well, the expected inflation level is, let's say, 3%, even though maybe current inflation is only 2. So you do today's calculation based on 2%, but then future expected inflation is 3%. Then you start crunching the numbers and you start identifying risk, right? Because that's what finance is about, right? What's the potential risk? What's the potential reward? That's what finance is. And if you can do it one calculation, even better. So, all right, so they're at 3%. Aussie's going to be at 2%. Okay, fine. Maybe a scalp in there. Maybe you're in a positive trade for a couple of days, but probably not a long-term fundamental play. Not yet. Now, if you can get like the yen trending down, because we get through the repatriation and we're in the new fiscal year, and the market says, let's short Japanese yen. All right, well, Kiwi yen long would be great. Why? Diverging central banking policies and positive interest rate differential. Okay, that's different than Aussie Kiwi trade, okay? Because it's really a yen trade. Kitty CAD, huge week for Kitty CAD, as you know. What's going on? USD CAD's been going up, which means the value of the Canadian dollar has been falling. Net positions are falling. And look at a little more bulls, a little more bears, clear as mud. Well, we got a lot of news out of CAD this week. Lots of news out of CAD this week. So maybe we'll learn something new. Maybe next week will be even better. And that's the week as I know it. And that's all I know about that. I might be a smart man, but I know what the commitment of traders report is. Hey, thank you for being on my team. I really appreciate it. I hope you get a lot of value out of these sessions. The team at Traders Way hopes that you'll value these sessions, that you're learning, you're growing stronger, and that when you decide to choose a trading partner like a broker to build your successful trading career around and upon, that you'll choose Traders Way, in particular because they're investing into you up front by making these events possible. So you take care of yourself. Trade safe. Be careful. Lots of stuff going on this week. Every session seems to be important this week. Every session. Can you imagine that? Every Asian session, every European session, every New York session. Wow. Opportunity to make money, opportunity to lose money. So be careful. Reward is a function of risk. Don't try to make a lot of money this week. Just do your job and very quietly, with very little risk, accumulate a little bit of wealth for your time. Let your account size grow. And let compound interest lead the way. Get rich slow, guys. Cheers.